started here in just a few minutes. While you're joining us, please go ahead and put into the Q&A function or the chat function where you're dialing in from today, and enjoy our background music, and we'll get started here in just a minute. Well, hi, everyone, and welcome. We are thrilled to have you here today. My name is Nicola Corzine. I get the honor of being able to host the conversation today on our fundraising optionality. And again, delighted to have all of you joining us. We're actually normally do these as webinars, but today we are doing this as a meeting so that we can see everyone's face and hopefully have an incredibly engaging conversation on this important topic in this time. So just so everyone is aware, we are live streaming this. So please do be aware if you are going to ask questions, they will be recorded and shared out on live stream. And on that note, you are able and invited to please submit any questions that you may have as we go through this material today into the chat feature, and we'll try to get to just as many questions as we possibly can towards the end. Now, before we get started, we have been doing a few polls at the beginning of every session just to try to take a heat sentiment on how our entrepreneurs are faring in this very difficult time. So what I'd love to invite each of you to do, if you'll indulge us just for a moment, is to sort of share in all honesty and transparency how you're feeling in this time between all of the challenges of the pandemic, the wildfires, social justice, a number of things that are coming at you hard, fast, and furious. We do want to be mindful of just understanding all of those pressures and being able to share that in great parameter with all of our entrepreneurs. So I'm going to go ahead and end that poll and share those results with people. A good, healthy dose of optimism, which we're always grateful to see. And that definitely has been trending that way over the last couple of months. So good to know, no difference today in that regard. Now, the next poll that we just want to launch is, as you may all be aware, we actually build programs for our entrepreneurs based on their top challenges in this time. And so your ability to sort of share with us what is keeping you up at night, to use that old euphemism, will help us make sure that we're putting on classes, workshops, learn-ins, webinars, mentors that can help you address the challenging times and the specific things that you need help with. Interestingly, not surprisingly, given this class that we're about to go through, finance is one of the top pain points, as is sales and the team. Which again, certainly given the remote environment that we're all finding ourselves in, managing and being available and supportive leadership for our team continues to be a struggling point. So just so everyone can see, that's the results of that second poll. Thank you so much for helping us be a little bit smarter around the classes and the workshops that we want to put in support of you. So again, without any further ado, my name is Nicola. It's thrilled to be here welcoming you to this conversation today. I'm going to go ahead and share my screen, and we're going to get started on a conversation around fundraising strategies for all of you entrepreneurs. Oh, and actually I see that I popped into my Acrobat. Let me stop my share and get into my PowerPoint really quickly. Sorry, guys. Give me just one second. Technical guffaws. No, still want to do that. I'm sorry. One last time, otherwise we'll go with the PDF. Look at that, third time's the charm. Okay, so fundraising strategies. It may seem in this time that there are less rather than more that are open to each of you, but we are really big believers in as much as possible that finding the fundraising strategy that works best for you It's going to be important to helping you get the results that you're looking for. It goes without saying, fundraising is a full-time job. So as being CEO of a startup company. And so the more that we can help you figure out the right path for you based on your needs, your unique needs, the better off we're going to be. So that's what we're going to talk about today. Just to give you a little bit of sense as to who I am and where I come from. I am the daughter of an entrepreneur, first and foremost. I say that because I didn't realize growing up how important that legacy was really going to be in helping me realize that I, too, had the chance to be an entrepreneur. But I went on in college to start my first company. I built 3 companies. One had a successful exit. 2 did not. One was a fine standalone company that raised no money. The second was the one that was acquired by Microsoft. And the third one raised way too much money and blew up in a glorious fashion. So that was my failure state that I needed to be reminded of the fact that I knew nothing. I then went on to do a very short stint in investment banking, which helped me understand the optimization as to how exits really can be formed and where the management of the exit really does come into being at a strategic layer. But it was not definitely my cup of tea, to use the Britishism there for a second. And so I ended up finding my way into venture. And I was very fortunate to ultimately spend 11 years co-leading Band of Angels, which is the oldest angel investment group. Made about 95 investments during that time and did 2 venture funds. And so while a lot of the content that I'm going to talk to you today definitely takes into play sort of my own experience and then also what I saw in venture, I think it's really important to note that there are many paths forward that I've also had exposure and experience to. And again, really believe that there is a fundraising strategy that is right for each individual founder first and foremost. You should not identify your own merit and your own worth by any one specific path. It's going to be about defining and building the right kind of company that matters to you above all else. And so let's get started. When you are thinking about what kinds of fundraising options may be best for you, there's a few things that you need to figure out. This is sort of the checkbox, if you will, of where do I even start? The first thing is, obviously you need money. But the most important questions that you should be asking yourself when you think about raising money is, what is it going to be used for? And then the next important question is, what do you actually have access to today? And access to today is resources in a very broad spectrum. So it's going to be people, it's going to be literal assets that you may have in your back pocket. It's going to be, technology, perhaps services, customers, all of the things that you have access to that should go into that bucket list. The next important question, and this is one that I want to slow down to really make sure we all understand today, is what are you willing to give up? And then equally important, what are you not willing to give up? I've had many an inspiring and rightfully good conversation with founders where they're like, look, for me, I want to build this. I want to be the leader. I want to be the CEO. And I need to know that I'm going to be able to lead this organization no matter what. In all honesty, if that is a critical aspect to what you're trying to do, then there may be some paths of fundraising that are just not right for you at this stage in time. When you take in outside owners or co-owners in your business, the ability to potentially just keep one title beside you is somewhat limited. So being able to sort of surface this idea of what you're willing to give up, what you're not willing to give up, will give you a sense of control and understanding as to the domains that are a no-go zone for you. And then also understanding sort of what are the current commitments that you have, both financially and time-wise. You want to be able to have sort of that inner reflection before even thinking about raising money. And I use all of that to say, we haven't even gotten to the how much, what's it going to cost me, who do I go pitch to? None of this matters yet until you have a little bit of this back of the envelope, honest conversation with yourself. Now, from that point in time, assuming you've done that, then you're going to have to start realizing you can't have it all, right? So what is the most important thing that really matters to you when it comes to fundraising? What is the 1 or 2 things that matter above all else? Maybe it is that CEO title. Maybe it is about being able to have a quality of life that allows you to, really prioritize a healthy work-life balance. Maybe it is, growing slow and growing intentionally. You don't have to grow at the warp speed unless that's the kind of business that you're really trying to espouse to. So prioritize within that laundry list. And that too is going to start illuminating, I promise, what paths of fundraising may be best for you. And so when we get into that vein, I think it is important to realize that there's an XY axis that's always at stake, right? There's the time to raise and then there's the amount to raise. And so what I'd ask you to do, if you haven't already done this, and just, if you want to share in chat, that would be awesome. I'm trying to keep this a little bit more, connected as a community if we were in actually physical environments today. But if not, just sort of have an internal conversation with yourself. Like, what matters the most to you? Are you trying to secure money quickly? Are you looking for the lowest cost option to raise money? Are you trying to find individuals or investors that can help have a huge pull-up impact in your customer baseline, in who you get connected to, in your media recognition? There's no wrong answer here, but your ranking of this, again, is ultimately going to help you figure out who do you raise money from, and when do you raise money, and how do you do it successfully, even with a pandemic potentially, right? And then on the back end of that, you really have to start figuring out, well, what kind of company are you trying to build? Again, not every company can, should, or must be $1 billion in value. But if you are trying to build a company that can be venture backable, that is a qualifier statement that we need to assert to, right? So, figure out what matters to you. Are you building a lifestyle company, one that you want to be able to control the growth and the speed and the exit timeline for? Are you looking to build a company that really does take off like that rocket ship, that really has that exponential impact to grow and scale in major ways? And if you want a faster exit, that's fine too, but then understand which of those dynamics make the most sense. Now, when we have this all in place, what we can start to look at is your risk and return profile. So this is when we start mapping on different investor products or different investor options for you, the entrepreneur. And again, you're in the driving seat here. None of these are right. None of these are wrong. This is just all options that matter based on your line of the spectrum. If you are an investor, though, it is important to realize that an external investor, think of these as not necessarily just angels, but largely on the venture capital scale, are not going to be looking at a lifestyle company as sort of meeting their goal and their criteria. Why? Well, because most venture funds have a time horizon themselves. They need to sort of look at generating a pro forma return within a 10-year time horizon. And sometimes that's not just going to be possible with the exit numbers that they're looking at on the lower end of the scale. There is the acquisition type of investor mindset. This often works very well with sort of your seed funds or your angel investor types, where honestly, a 5 to 7x return in a 7 to 9 year period is great. That's phenomenal. And these are not bad places for them. The venture capital firms, the traditional names that you would look at, are going to be in the upper right quad, where they're looking at the $1 billion type of company level. So find your retirement level and then, or find your exit level and then sort of work backwards from there. So to go into that a little bit more, I think it does help to sort of delineate, well, what are the expectations around a lifestyle company, an acquisition, and an IPO company? On the earlier slide, I referenced a timeline on an acquisition company kind of being in the 7-year exit horizon. Most investors like to know that there are acquisition sniffs coming in a little earlier. Sometimes, like our last fund that we did at Band had a specific 5-year trajectory where we were looking for exit offers to present themselves within 5 years. Doesn't necessarily mean that the company was taking that exit offers, but it does mean that they had hit enough of an inflection point that buyers were potentially around in that timeline. So 5 to 7 years is generally a good speaking of an acquisition type of profile. The lifestyle companies, that is a grow slow and grow steady and grow at your pace mode. So you can take in small amounts of capital at different inflection points that are not necessarily just about milestone based. We often talk about, is this right for friends and family? Well, if you had friends and families that might want to invest in a lifestyle company, that's fantastic. But these are also more traditional kinds of lines of credit, traditional loan options, credit card options, some limited government funding, but not much unless you're sort of in a specialized zone there. And then, of course, on the IPO side, as we talk about, these are definitely more of your traditional venture-backed types of companies, raising your first round of capital sooner rather than later in order to keep up your competitive differentiation and your defensibility for the long run. From that point forward, the fun part begins, right? So now you get to think about, who is it that I'm actually going to go after, and where and when am I going to go after them? So we start by building out your funnel. Now, as you see here, I generally have a rule of thumb, not dissimilar to sort of growing a sales funnel for customer base. You have to manage this list. This list needs nurturing, it needs focus, it needs prioritization. So it should have no more than 10 to 12 targets at any given time, because if it grows too big than that, you are going to have a really hard time managing those relationships. And yes, this includes all of the funding layers that we looked at on the previous slides. So for the most part, really get very specific on drilling into knowing as much as you can about your influencers within that list. So who's in your network? Well, start by building out and asking other entrepreneurs that have raised sources of money similar to the ones that you're thinking about. Look at advisors, look at mentors. And if you're like many an entrepreneur, including myself once way back when, start building out that network today. It's never too early. There was a great question that came in the pre-registration on like, will investors take a meeting with me when I don't actually need to raise money? The answer to that question is a resounding yes. Perhaps not always an emphatic yes if they're super busy or trying to close out on a deal, but some of the best time to raise money is when you actually don't need to raise money. And part of that is just to sort of build up that connection, that conversation, to understand what it is that you're working on. They can be a tremendous source of information and inspiration to you. So even if it's not the right fit for them, never be afraid to ask sort of like, is there anyone that jumps out to you, any other syndicate partners that you could recommend or reference as being a good fit for me, given where I am or given where I'm hoping to be when I raise? What kind of metrics would you expect to see from a company who might be able to successfully raise? Who inspires you in this field? What other people are doing interesting work in this vein, right? Have sort of your 5 or 6 target questions that you always want to go out to investor informational meetings with, and then start prioritizing that list as soon as possible towards building up those relationships. Similarly, make sure you perform due diligence. Due diligence is a two-way street. I know it can feel like, well, that's nice for you to say being on the other side, but it really is. These are relationships that you are going to have, especially in sort of the angel venture world, but even on the banking world, 10, 12 years from now. Do business with people that are value aligned to you, right? Do business with people who believe in a similar vision to the way that you do. And so if you're going to prioritize that, that means you have to nurture those relationships. That means you have to get to know them and they have to get to know you. And that's performing diligence. It can't be rushed. Nothing hurts the heart harder for me than when I hear entrepreneurs that are like, well, I got 2 term sheets and I just need to pick one. I just got to get back to building the business. I totally understand that mentality. I really do understand the pressures of time. But at the same stage and in the same space, if you don't have the chance to sort of slow down to make sure it's the right investor joining you, they will be with you forevermore. We just had an amazing guy, Rob Chestnut, in for an author in residence, and he shared, these are investors that are with you for life. So choose your investors carefully. Really choose your investors carefully. Reverse engineer your connection, right? Ideally, you're going to find at least 2 referrers into each lead that you're growing in your funnel. Nothing is better, and you should and absolutely must outreach them directly as well. But there is nothing better, nothing that makes it easier than if I would get somebody going, hi, I'm so-and-so, and I'm building X. And I'm like, oh yeah, so-and-so was telling me about you the other day. I was hoping you'd reach out, or it's great to meet you. I'm looking forward to learning more. So try to warm up that lead and then go all the way through if you can. And then try to create moments of activation for each of these potential customers, if you will, right? What can you invest into them? How are you building up information flow to them on an ongoing basis? Most of the time, it's going to take you 4 to 6 months if you're building out from ground zero all the way to closing a major round. And of that, again, obviously I'm talking mainly on the venture and angel front. On the banking front, you might be able to go a little faster, but even there, we heard recently 2 months for review, right? So how do you create moments of activation and interest as you're going through this process with each potential capital allocator? And then as you qualify people out, keep building that list. So just because I say you have 10 to 12, you never really want to get that list down lower than 6. If you do, it's going to be harder to build it back up when you need it. So grow that list, cultivate that list, keep asking entrepreneurs who they're getting funding from, who's inspiring to you, follow them out and see how you can get introduced whenever possible. All right. So now let's talk about the how much. This is always a fun topic and debate out there in the world. I like to look at it as sort of a few-pronged strategy. The first is, what do you actually need to accomplish to get your company to the next stage of success, right? So this is milestones. This is what has to happen today in order to achieve that milestone in the future. And then how long is it going to take you for you to get there? What pieces are missing, right? And pieces can be human, pieces can be product, pieces can be services, pieces can be logistical, pieces can be any number of variables. Each of those variables has a quantifiable cost associated with them and a time associated with them. And then how long does it take for you to raise money? Are there seasonality issues at hand? Interestingly, as hopefully many of you heard on a recent panel that I was inspired to host with other smart investors out on the stage, they're saying there's still a ton of money that is flowing in at the seed level. A ton of money flowing in at the seed level. So we are not seeing a lag right now in the pandemic around raising at the seed level. Now, we may over the coming months. So again, the closer and the more important you can keep up to relevant news in this time, the better off you're going to be. But right now, there is not a slow to the seed funding level, which is great. So that means, your 3 to 4 month horizon should be about right. If you are building from zero, again, though, please plan on 4 to 6 months because it takes a while to cultivate, nurture, build interest, grow the coalition, because you've got to go through that whole syndication process, which we'll talk about in just a second. And so if we are talking on the angel and VC levels, obviously there's a few pieces and places that need to be in already. The first is, make sure you have your cap table ready to go. You're going to have your common stock and you're going to have your preferred stock. Certainly, if you're raising from angels and VCs, there is a lot of interest in raising against common stock. It doesn't always have to be preferred. Many of you may have had some successful experiences. I'd love to see if anyone wants to share in chat around raising a seed round in this time and raising against common versus preferred. That would be fascinating to see from those joining us today. Historically, if you're going to go beyond just a single round of raise, most of the time people are going to be thinking about converting into preferred stock for all the right reasons. So they may be joining you in one level or maybe joining you on a note, and then that will convert into preferred. You do want to think about your option pool. Again, if you're going into sort of the traditional rounds of venture or angel financing, at the very first layer, usually 12 to 15% is what people like to see in the option pool before coming in. They don't want to suffer that dilution on the other end. So if you can get that in up front, that's going to make things easier and faster for them. Usually the question I get back is why? Why does it need to be that high? Honestly, it's usually because you're a smaller team, right? You might be a team of 3, 5, 10 people. You've got a lot of really critical hires ahead of you, and we don't want you to have to slow down to come back to your board to request additional stock availability in order to attract and retain the top talent that you need to go as far as possible. So to do that means you just need to have a healthy option pool available for you to be opportunistic with your hiring needs. The next important element is thinking about your seed round, getting it all buttoned up and ready to go. Your convertible notes, right? One of the hardest things often at seed round, and seed, just so we're qualifying here, can be anywhere from $500,000 to about $2 million. That usually lives in the seed bucket round. I have seen that called Series A. By no means is there common language that lives around this wild west of fundraising. Either works, but traditionally seed will carry you up to about a 2 million mark. And so one of the hardest things in raising that money, especially if you're on the upper end of that spectrum, is herding the sheep, as it's lovingly called, right? How do you find a lead? How do you get that lead to put through the term sheet? How do you then get that term sheet articulated out amongst other partners? Because that lead may be good for $500,000, maybe they're good for $1 million, but they're probably not going to do a one and done where they're taking the full round. So to do that, there's a couple of tricks that have worked historically well that I can share with you that other entrepreneurs have used. One is to be able to offer a discount up to a certain point in time. The best way to feel genuine around this is if there is a reason why you're putting out a time and a date in place for that discount to be available. So for example, if you are in if you're in a revenue environment where you're already generating revenue and there's a big customer decision that is coming up in the next 6 60 days, and closing that deal would have a future impact in the value of your company, then to give a discount prior to that point in time before the customer has made the decision makes a lot of sense. The other strategy that you can use is sort of what we call a kicker mode, where it's like, if you come in now, we'll give you an additional coverage of warrants, or we'll give you an additional coverage of options. That one's a little harder, because often you'll find the later investors are like, well, why can't I get that deal too? So just be prepared that you may have to end up carving that option out for everyone in the round. But discounts and kickers are your friends. Feel free to use those if it helps as you're trying to syndicate out and get that lead investor in, which is the hardest thing in closing your seed round. Finding somebody who can lead, finding someone who will lead. Always and never be afraid to ask that question when you're out pitching. Do you lead rounds? Because your job is to find people that say yes more often than no. If you have a bunch of really interested people that say, keep me posted, let me know when you've got a lead, it's just going to make the time drag on to the upper end of that 6-month horizon, if not longer. And then, you know, on the valuation front, and we'll talk more about valuation here in just a couple of minutes, but realize there's a pre and a post conversation, but honestly, the most important thing for you guys to think about is percentage ownership, way more than just a hard-coded number. I'm a real big believer on that matters more than anything else, which we'll talk about. So what are some of the things that can trip you up in that pre-financing mode? Again, if you're going out more after, you know, the traditional types of angel VC style, your company structure. Not always, but the majority of time, if you're planning on raising multiple rounds of institutional fundraising, you should not be an LLC. You can be an LLC if you are a lifestyle company. You can be an LLC if you're raising from a small number of angels, call it sort of under the $1 million mark. That works fine. But above and beyond that, it starts to get really messy. And most investors need to see more of that traditional Delaware C Corp style of structure in place. Not having that option pool that we talked about before. Not having your assignments in place. For those of you who may not know, and it's absolutely fine, but assignments basically say anyone who worked on your company needs to assign all intellectual property, whether it's perceived or real at this time, to the company. The company must own all assets. No individual can own an asset. We've all seen media stories and certain discrepancies in the past, a la Facebook in this environment, right? So make sure all of your assignments are in place, because that paperwork again can slow things down, and your job is to speed things up, not slow things down. Not having your due diligence materials ready to be shared when asked for. If anyone's interested, I don't cover it in this talk, but I do have a due diligence checklist. We can easily send that out if anyone's curious around, well, what are my due diligence checks? Just let me know, and we'll be happy to share that here. And then also just not knowing generally a reality check on market research on your comps, right? Like, how much are people raising right now? What is the environment from which people are raising right now? What is the general valuation for which people are raising right now in your industry or adjacent industries? So on the company structure side, as I say, wherever possible, try to keep that timing in mind. If you do need to switch from an LLC to a C Corp, it's usually about 4 to 6 weeks. It can be done as fast as 2, but keep that in place. And then, like we talked about on the option side, filling that pool on the front end, because investors simply don't want to suffer the dilution before they actually begin on the giving you the capital out, right? Like if they're giving you a certain valuation and then they have to see you give away even more capital in support of achieving more talent coming into your company, that can be really challenging. And then also just remember, options are your friend when you can't afford to pay people. Totally get it, but they're not Skittles. They don't always reinvest themselves easily. So try to limit who gets options, under what reason they get options, and making sure it's diligently done. The assignments like we talked about, really being intentional to make sure everything is assigned back into the company. And then also on the diligence front, there really is, when you're not raising money, it's a great time to start getting your due diligence folder together. Planning ahead now will help keep this shorter and faster for you. So now let's go ahead and talk about the most important thing I think that's on everyone's mind, valuation and valuation methodologies, right? There is some software out there, but in all honesty, especially when you're raising your first round of capital, nobody is using software to sort of back up the claims as to how much you're worth and for what reason. You may have gone through a 409A evaluation, and that's fantastic, although most of the time 409A eval places will say, or Captiva will say, hold until you've done your outside equity round. In which case, you know, just being mindful that it's an interesting perspective on what your company may be worth, but not necessarily valued in the way investors look at it. So like we talked about earlier, it's really not about the number that they're going to give you. It's much more about the percentage. So for an entrepreneur raising, the question that should be on top of your mind is, what can I do to mitigate risk? Because for most investors, the thing that would keep me up at night is, can my company get from point A to point B with enough of the money that I've given them so that they'll yield a higher valuation at the next round? The death point to investors is when that doesn't happen, because then we have to either continue to fund the company until they do get there, or suffer a down round or a flat round. And those are not your friends. So for the most part, your job is to help us see how you've mitigated the risk to that statement not being true. So is there things that are referenceable about you and your team that give us strong opinions as to how you perform and meet timelines and deadlines and plan accordingly and exceed expectations when it comes to those types of environments? How long you're taking to get to the next round? It is crushing to us, usually on the investor front, when we hear entrepreneurs that say, I'm going to go raise my next round in 6 months' time. Part of that is, again, if you're raising in 6 months' time, you actually don't have a breathing moment to accomplish the milestones that you need before you're back out in market. So a general rule of thumb, and in fact, in the current environment, as John Chambers and others have been talking about, you really need 18 months of cash in the bank. So somewhere between 12 and 18 is what I would expect to see if I was being pitched today for what you're looking for from a time for the next round. The scale and the impact for which you're trying to achieve these, the total capital that you require to get from here to point of exit, right? Not here to the next round, but here to point of exit. Have you done that math? Do you know what the inflection points are? Do you know where the risk points are? Who you've attracted to your team? But credibility is the number one reason that investors will invest in you. And the greatest thing you can do to enhance your credibility is to show us who you've attracted in excitement and anticipation of the world that you're building around you. And if you have great people that are sitting there going, this is the best thing, I can't wait to join them full time. You've got advisors, you've got mentors, you've got other team members that are sitting there all in. That is one of the best things you can do to mitigate your risk right now. Your job as a CEO is always to be attracting top talent around you. And so show us how you're doing that in this moment in time. And that will help, I promise you, when it comes to mitigating risk in the investor mindset. And then your business model validation, right? Again, it's kind of capital for capital's sake. So how have you validated, mitigated risks around what model works for you, what you're experimenting with, some of your hypotheses, who's already signed in saying, if this thing was available tomorrow, I would give them X for Y period of time. Do you know how long it takes to qualify an account? Do you know how long it's going to take you to build up a qualified funnel? These are all the types of questions. And again, it's not the answer that matters, guys. I really want to be slow down to make sure you understand that. There's no right answer here. There really isn't. Is that you've thought about it and that you can articulate your thinking and that you can let us see inside of it. Because the most important thing here is that we're getting a chance to see and understand who you are, how you think, and why you're motivated to build this despite the risks. Because if you're not all in, that's our biggest risk, even above what I just said around, like, will you get to the next round? Like if you're not even all in, there's not going to be future rounds. So we have to know that you're all in. And the best way to see that you're all in is who you're attracting around you and seeing inside what your motivations are, right? Are you building a lifestyle company? Are you really excited around changing the world and building the next billion-dollar company? So on that note, probably one of the most useful things that I reflected on from hearing from a ton of smart investors and mentors over time is, realistically, companies don't fail on technology. They really fail on execution. And when it comes to execution, most of the time they're failing because they weren't able to see around the corner. As a startup founder, one of the biggest things you have going in your corner is the ability to be nimble and to not be weighed down with not asking the question. You've heard, I'm sure, of the ABCs, right? As a founder, you're also always closing, whether that's closing investors or closing deals, you're always selling. Welcome to that land. If you didn't know that you'd already signed up to be EVP of sales in your company, you have now been anointed as such. But also the other most important ABC rule that lives here is always curious. You have to always be curious, right? What do you see as threats, as opportunities, as differential states that large enterprises, existing players don't? Because it's going to be execution that enables you to thrive and flourish way more than it is technology alone. Great technology will die on the vine if it is not met with great execution. So what are some of the things that can get in the way of realizing a healthy valuation? And there's a few of them for sure that have been collected over time. I think one, realizing, like we talked about, getting a lead to price the round is one of the hardest things to do. Strategies that work, certainly with the pervasiveness of convertible capped notes, feel free to use a safe note if you're up for it. Feel free to use some of these common instruments that are available. You can see some great opportunities like this. Our friends Wilson Sonsini have a ton of really great insights that are available on their site, and you should definitely reference that. And it's all available for free for entrepreneurs. Don't shop term sheets intentionally, right? Like, that's never a good feeling when it's like, well, I got so-and-so from this investor group. Are you willing to meet it, exceed it? Where are you going to come in? Focusing only on your exit comps, or saying, look, we're the Airbnb or Uber or Snowflake of X, right? Be very careful in saying that you're just like another company that is out in the space actively right now. Shortening your runway to less than 12 months, like we talked about, and especially in this time zone, I really would encourage you to think more in the 15 to 18 month zone if possible. Claiming that you're going to be cash flow break even and knowing that timeline before you're even in market, try to avoid that. Obviously, we're going to ask you hypothetically, when do you think that time to break even will be? But really be intentional around what you need to learn in order to be more concrete in your decision making around that. And, claiming 1% market share before you've even necessarily validated what your model is going to be. Obviously, that's another thing to just watch out for. So math that does work, if you're going to try to control the valuation conversation, well, reverse engineering your 3-year financials if you're in market. Doing a bottoms-up approach on knowing, the value of your justified accounts, the value of your pipeline, the value of your team. Here is a really fun one, right? Because value of team can be exponential when you start adding this person plus this person plus this person. Gives us a whole horizontal approach to knowing, this space unlike any other. So really think creatively, and not just creatively, but think intentionally around who is coming into your team and how you share that information with potential investors. And then looking at comparable competition, be careful. Ideally, you're looking at adjacent sectors rather than direct sector competition. But that is always helpful math to have available in valuation conversations. And so if guidelines help, typically in a larger Series A seed round, you might be looking at 20 to 25% cost of ownership. Not always. Certainly if it's an anomaly, you can see that go down radically. But traditionally over time, the data suggests 20 to 25% ownership at that first round, and then about 15% at your Series B. The same is true for C. Sometimes it can go down to about the 10 to 12% level, but most of the time it's 15%. And then D is about 10% and E is 5%. So if you are adding that all up, this guy's face kind of says it all. Yes, I am being very serious that is expensive capital. That's why we say it's not right for everyone. But do remember, founder stock exists for a reason. If you are providing value to your company, you will continue to get refreshed. You will continue to get energized. You will have double triggers that are in place that protect you and your co-founders. We promise above and beyond sort of what is required of their investor interest. In order to keep their interest levels, they have to continue to keep investing at pretty rigorous and expensive rates. And this slide I left in because historically I would be like, oh, you never know what the future is going to bring. Obviously, we have been, 2020 is a year to say the least, and it's a year of interesting times in the capital markets. There are some that have asserted that time is going to come to a reckoning where the money is not going to flow as freely and as easily as it has. And in all honesty, I think it's much more important, again, that you find value-added investors that are with you for the long run, rather than trying to capitalize just on like the easiest and fastest money. That never serves our entrepreneurs well. It is much stronger when you can really lean into saying you are taking people's money, but you are building relationships by taking people's money. So who are the relationships that you want around you, building the business and the vision, and holding the truth to the vision that you see for the future, right? Most of them are going to be on your board. Most of them are going to be around you as influencers to the business. Surround yourself with influences you're excited and inspired to have. And in all honesty, if you don't take in the capital and you really feel that you have to have that capital around you in order to ensure that you're growing at the rate that you want to, then you're going to limit your own scalability in that curve. So I do encourage you to realize that, you know, for angels, this is their dollars that are going in. So they want to really be passionately connected to the entrepreneurs that they're investing in. This is their own money, their own heart that is going into the deals that they're self-selecting. For our venture funds, you know, there is a thesis that they may have in the world or a specific domain or sector, but they're largely dictated by their vintage years and the limited partners that they have around them. So there's a time to exit. And when you're out meeting funds, one of the things you need to be thinking of is, where are they in that vintage year spectrum? Are they able to make very quick decisions on investing in new deals now? Or are they really on the end of the spectrum where they're holding most of the capital for follow-on financings? And then equally, if you are planning on needing to raise multiple rounds, be very intentional in asking the question, do you participate in follow-on rounds? Do you have access and visibility to the capital that you've set aside for your deals that come into your portfolio to support? Because that is an incredibly critical signal in market when it comes to raising the next round. You want to be stacking the odds in your favor of hopefully taking less and less time to raise each subsequent round of capital, right? Don't find yourself in an environment where every time you need to raise is like starting from ground zero. That's going to be just very difficult on you as a founder. And if we can avoid that, that will be fantastic. So I am thrilled to say that we ended a little bit early. That's everything that I wanted to kind of share presentation wise. I'd love to use the rest of our time together, which we've got about 15 minutes, really to answer any questions that you guys have. And certainly coming in on the chat, we had quite a few of those. So let us start with some of the pre-selected ones, if you're okay. So a couple of questions coming in on like, okay, how are we going to meet investors in this current environment when we're not exactly going out and networking with people like that we used to? This is, again, working that network zone, super important. So first, we're going to build out that list, then we're going to get introduced, then you're going to have Zoom meetings. And yes, as we have heard from Flying Fish to NEA to Mordavidao to Sequoia to Kleiner, everyone's in a similar environment right now where the initial conversations are happening via Zoom. So what does that mean? Well, it means that you should probably plan on a shorter initial time to pitch. If you were physically in person, a lot of the VCs would say plan on an hour. And my general rule of thumb was, well, plan on an hour, but realize crises come up and you might actually only have about 30 to 40 minutes. And if you're doing all the talking in those 30 to 40 minutes, you're not engaging, and your job is to engage and get to the next meeting, not to get to the check in meeting one. So to do that, you should have about half of your content and half conversation. So that means about a 20-minute pitch and a 20-minute conversation, right? In the normal world. I would say shorten that by at least 25 to 30% in a Zoom-driven world. We're all Zoom fatigued, more so than ever before. I am sure, not dissimilar to me, there's probably, would say, any given day, 10, 12 Zoom meetings going on, maybe even more. So how do you try to combat that Zoom initiative? Be engaging, be thoughtful, connect at a human level. Lean in, own the screen, make sure that it's not just there to try to push as much content to them one directional as possible. Really go in with thoughtful questions prepared and show up with that same level of calibration that you would in person, right? So be professional to all ends. And again, ideally you're showing up, you know, not just to pitch, but to learn. I always find that the most engaging meetings are if you can walk away with a follow-up action item that is concretely known. For most investors of general partners in venture firms, you may be aware of sort of the 3-meeting rule. 3 meeting rule goes something like this. Meeting 1, you might be directly connected to the perfect partner inside the fund, but probably not. You're talking to either junior partner or associate, someone at that calibration. And their job is to sort of go through to an initial vested level of engagement and interest and say, yeah, this meets enough that I want to bring in the right partner to the next conversation. So then you would have meeting 2, and meeting 2 is usually double the length of time, and it typically is a lot more engaging. If meeting 2 went well, you would then be discussed at the partner meeting, and partner meetings used to be either Monday mornings first in the week or sort of tail end of the week. And at that stage, they would discuss across the table. Every partner might have met with a couple of entrepreneurs during that last week period. What deals were interesting? What were the things that they would need to see? What stages are coming up that they want to be mindful of? What are the other partners' considerations, concerns, objections that need to be taken into account? And then they would roll through and go back to all of the entrepreneurs that they've met with and basically say, okay, this is the next steps, or we would want you to come in and present to another partner or 2 partners. So that's a very calibrated process that, believe it or not, is still happening in the remote world. The timelines have changed a little bit, just again, because availability of like being able to do deals and the competitive nature of doing deals has shifted it from being like so orchestrated to we only look at deals once a week in a partner style setting. So there is more fluidity to that assessment and that diligence, but that's still the general cadence. So now let's flip to the angel side of the house, right? So angels, as I can honestly attest to, and I'm sure many of you may know, we used to meet monthly. And monthly, we would have a beautiful networking environment over breakfast, lunch, dinner, whatever the choice may be, where we would have evaluated anywhere from 50 to 75 deals and brought that down to sort of a 3 to 4 number level, depending on the group, that would present to the entire angel group. And each entrepreneur would have about 15 to 20 minutes on average to sort of go through their baseline pitch. And your job there was to cultivate as much interest within the group so that you had in due diligence, which would be the next step from an angel group meeting, about a 2-hour conversation with a subset of the members that were most interested in your deal terms. That whole process from the initial point of entry to the point of presenting at the dinner to then doing the diligence would be about 2 months of flow. Right, so you can see the difference in timeline horizon there. Believe it or not, they're still doing virtual meetings, and they are still doing monthly for the most part at the angel group level. So just keep that in mind if you are building up your influencer strategy on more of the professional angel groups, finding out when are they hosting their virtual meetings, asking what's needed or what's worked well in a virtual meeting setting. Those are kind of the tips and strategies that will really go a long way. I will say for angel groups, another hack just to be aware of is you need to have someone that can be the voice of you when you're not in the room. Of course, that's also true on the venture side, don't get me wrong. But generally speaking, you know who that advocate is. It's either your initial point of entry or your general partner that has the most knowledge in that space. With angels, it's a lot harder to figure out because most groups have somewhere between 30 and 150 members. So how do you find an influencer that has the trusted voice within the group when you're not present? And that's the part to really home in on. If you can find your influencer or a couple of influencers inside the angel group that will carry your interests forward when you're not present, you will be much better served. Finding that internal lead is always the hardest part of working within a professional angel group. It's definitely part art, part science for sure. So hopefully that helps a little bit. I would say it is business is as new usual, whatever that means in like a virtual world. Again, feel free to show up with a coffee or with a drink. Don't eat, right? You know, none, and all of the things that you would expect to see. I don't think at this stage any of us don't know how to be professional on Zoom, whether we like it or not. It's really difficult. I will say, be authentic and be engaging. Right? Let us see your personality. Your personality has to shine. People do business with people they like. Be likable, and not likable fake, but just like let us see your excitement and your energy and your enthusiasm for why you're building what you're building. Don't shy that away from us because it's going to be really hard to sort of want to continue the conversations because that is required no matter what. Another question that came through is focusing on selling an idea. And to this level, I'm going to say it's really how do you pitch or find the right kind of investors when you're super early. And I think there again, it's going to go back to some of that checklist that we talked about, right? How do you mitigate the risk? Sure, ideas are always risky, but you know what? There's a ton of businesses that are open right now that are also risky, unfortunately, as we know all too well. Many that are having to pivot and find a new model because of this terrible pandemic that we all find ourselves in. And so, to that end, an idea is just one stage of a trajectory, but your job is to show how have you tested and validated that idea as much as possible? What are the levers that you can use? Have you had informed conversations with potential customers? Are those potential customers able to write an email to you that says, under this conversation that I had with so and so, and my understanding of the product or the service that they're trying to scope in the world, I would be very interested in being able to be a part of the pilot. So what are signals that matter? Getting some kind of sense of like engagement or next steps that a potential customer would take. Getting some kind of sense or commitment as to what it would take to close an advisor formally to your company. Having advisors formally a part of your company. Having some kind of research initiative or collaboration that's around a new idea or a new approach that may be coming to market. Having some kind of media recognition, having some kind of approach that talks about why you uniquely are positioned to be able to do this work. All of those go a long way to saying, it may be an idea, but it's an idea that I don't want to miss out on, right? And again, your job is to cultivate and curate interest, not just by the stage of the company that you're at, but also by the type of investor that is drawn to that type of profile. Different investors have different risk profiles, similar to customers, right? Not all customers are Renaissance customers. Not all salespeople are Renaissance customers, right? Meaning that some customers, no matter how great a startup idea it may be, are never going to buy from a startup. It goes against InfoSec. It goes against compliance. It goes against their DNA. Your job is to cultivate and find great customers who are willing to overlook that because of the upside opportunity and the innovation curve that they sit on. Find the innovation curve that matters at the investor lens and focus on identifying that first and foremost. That should go into your matrix of your 10 to 12 target customers that you have on the investor qualifier list, right? And when you're talking with entrepreneurs who have gotten funded from similar entities, be very specific and say, this is where I am on the innovation curve. I'm just an idea. I have a couple of potential customers that have said, I might buy this widget from you when the widget is available at X price point. Where were you on the innovation curve when you raised from so-and-so? Were you further? Were you earlier? That will help benchmark whether or not the risk pro forma of that investor matches where you are on that same spectrum. All right, let me go back into the chat and see some of these other great questions that have come in. Hopefully that's helpful, guys. Gosh, Colin, I'm talking to my Colin here. It's hard. There's some really great comments that are coming in, some really kind ones too. Yes, slides are definitely going to be available, guys. Don't worry about that. Focusing in on a vertical sector and expressing domain knowledge. Yeah, you know, for many investors, there's two types out there in the world, generalists and sector focused. To the extent that you may be in a specialized domain, what do I mean by that? Life science, bio, AI, machine learning, autonomous vehicles, the list goes on and on. You will probably find a handful of investors that are really well known in that. Now, your job as an entrepreneur is to not just know those entrepreneurs who have already made a bet, but ideally to find ones that typically have not yet made a bet in that space that syndicate with those partners. So a lot of the times we'll hear from entrepreneurs, well, I'll pick on Kleiner. Or no, let me pick on Andreessen today. I haven't picked on Andreessen. Andreessen has already funded a competitor in this space, but I think I'm a greater addition than what Andreessen has funded. Should I pitch Andreessen? Great question. The reality is you can absolutely, obviously, the one caveat, and I think it's just important to be very honest in these types of conversations, investors don't sign NDAs usually at the very beginning marks, and you really shouldn't ask for one. It's just kind of not PC of sorts. But please know, with all honesty and all authenticity, our reputation is everything. If we screw up and it was ever found out that we did something that was not above board in not protecting your information, the thing that would happen is that we would no longer be pitched. We would no longer have deals that came to us, and nobody would want to work with us. And if we did that, it was game over. So reputationally, investors have 1,000% going in their favor to make sure that they don't do things unethically around giving out secrets. And so you too need to make sure that you're not giving away absolutely everything in a meeting, and hopefully you would never do that. But do be a little careful, obviously, and just not letting too much information pass out on that first session. However, that being said, ideally, you're not going and pitching to someone who has a direct competitor, like you literally have your competitive slide and they're like, oh, they funded this person. That's not probably going to be the right fit. That's where the adjacent sectors can really make sense. And more interestingly and more importantly, if you can find out that Andreessen typically syndicates with, I'm just going to make this up for ease of use right now, NEA, Battery, Bessemer, and NEA and Battery have not made an investment choice in that space yet, I might encourage you to think about going and trying to get connected into NEA and Battery first, rather than going directly into Andreessen, because typically you're going to see similarities. A lot of investment firms, though, just so you know, do have a thesis of we want to build up a portfolio of, say, 4 to 6 companies in a sector. Now, again, no cannibalization. No one is like, and the best will win, and it will be like some kind of weird Roman death match at the end. That's not what they're looking for. They're really looking for intentional growth of a sector and intentional ownership of a landscape and trying to build through from that thesis. So I think I've got time for maybe one more question. Let's see. Documents that are needed. If I had a nickel for every executive summary rewrite that I have done in my life, I would probably be extremely wealthy, above and beyond any returns that I've made in my portfolio, for sure. Your executive summary, your one-pager, your PowerPoint deck, these are important support systems that you have behind you. But they're important as backup documentation to your idea, not the thing that will get you funded. So at a minimum, I would say you should have the support system that you need to feel confident in pitching. If you wanted my general rule of thumb, I would say a one-pager, and there's a bunch of really great templates out there. Happy to share a few of those in our follow-up conversation today. But there's also just some really good blogs that have been written on the subject too. Techstars has got a couple of really awesome ones out there. And then equally, you should have your PowerPoint deck. Your PowerPoint deck should be a 10 to 15 slide, no more, initial point of conversation. And again, remember, most of the time you're going to be sharing that after a presentation. So make sure it is not only needed to be driven by you in a presentation, but it can also be shared. So I often see 2 versions of that, one that's more of the shareable PowerPoint and one that's more of the driven PowerPoint. Those are your 2 elements that should always be present. And I would almost say they should always be updated. Nothing used to be harder or more disappointing than I would get an executive summary sent over the wire and we'd open it up and it'd be like written from a year ago or 2 years ago, and you sort of sit there and you shake your head. You're like, well, I know this matters so much that they wrote it a year ago and they didn't need to update the date since. And sometimes it's just a matter of an overlook on those types of very tactical logistical issues, and that's fair. Entrepreneurs have 1,000 things going on any given day, but to the extent that this can be a living, breathing document that actually matters and transforms your company and really narrates your vision and narrates where you are, do that. More importantly, even than the initial materials, guys, though, I would really encourage you to think about your follow-through materials. More likely than not, you're going to navigate and curate really amazing relationships that come out of pitching potential investors, some of which will never be investors, but they may be your biggest champions and advisors and influencers in the world. How do you keep them abreast and apprised of the developments and the milestones that you're making? What is your communication strategy with them? I said that these are influencers of the company. Whether they invest or not is almost a secondary outcome, right? In fact, if you can have them be a value-added supporter, absent capital or absent sort of giving up equity, all the more powerful. You've just created a non-dilutive source of support for your organization, win-win all the way through. And so to the extent that you're doing weekly or monthly updates that are really directly providing the information that they need to be your champion out in the world with some very clear asks from you, what are your 3 things that you're always asking for? Connections to probably talent, connections to investors or capital allocators, and connections to customers. So always be thinking around how are you curating engagement within this investor profile and keeping them going, keeping them excited, keeping them energized, and keeping them talking about you above anyone else. If you do that, good things will happen, whether or not it's directly dollars flowing from them or dollars flowing from people who are influenced by them. But good things will happen, I promise. Well, guys, I see we are almost at the top of the hour. It has been a pleasure really connecting with all of you today. I hope this is the start of the conversation and not the end of the conversation. We remain committed in this time to really being available and supportive entrepreneurs who are building so much opportunity for us in the world. And again, on behalf of all of our sponsors and supporters who make this work possible for us to provide to you, thank you. Let us know how we can continue to help and support. Stay tuned for some of that information that I referenced being flown out after today. We hope you have an amazing rest of the week, and we will see you at an upcoming event soon. Take good care. Bye-bye.